Hello friends, in this video I am bringing to you the case study of a company which is one of the market leaders in the pharmaceutical space in India. I've got a lot of requests from you guys to make the case study of Abbott India, and that is why I've brought this to you. I hope you like it. If you haven't subscribed to my channel, please do subscribe right now and hit the bell icon and turn on your notifications. I am Varun Agarwal, and do watch the video till the end because I am bringing to you the research of 2 to 3 days in a concise form of 15 to 20 minutes. So don't miss watching the video till the end because this will be very helpful to take a decision whether or not to invest in this company. And let's get started. For over 75 years, Abbott India has been helping millions of people in India to lead a healthier and fuller life. So this means that this company has a long legacy of about 75 years in India. Abbott is one of the largest healthcare companies in India. It's a multinational company which was established in India in 1944. We know the top few brands of this companies, which are Digene, Brufen and Cremaffin. It is one of the fastest growing healthcare companies in India. Apart from manufacturing medicines, it also is into various initiatives like Making India Thyroid Aware, A-Care, which is an online platform connecting the healthcare professionals like doctors with normal people like us. It has more than 3,500 employees working, and it has 6 brands of this company appear in the top 100 brands of Indian pharmaceutical companies, and 9 out of 10 brands of this company are the market leaders in their own segments. So whatever top brands this company is manufacturing, those medicines are the market leaders in their own fields. It has a manufacturing plant in Goa, and it has a distribution network of more than 70,000 retailers, 4,400 stockists and 24 distribution points. This company gives a lot of importance to its internal talent and employees, and it has very low employee attrition rates. It also has implemented a unique idea of reverse mentoring, wherein somebody new joins a company. After a few days, he teaches the senior people how things can be improved and how technology and other new things can be used. These are the key people of this company. The managing director is Mr. Ambati Venu and the chairman is Mr. Munir Sheikh. These are the leading market brands which are manufactured by this company. You can read them from the screen. A few popular ones are Digene, Cremaffin, Vertin. So these are the few popular brands, and if you see in their own fields, a lot of them are ranking on the first place. And if you see the market share also, there are certain brands which are having a market share of more than 50% also, and close to about 25 to 30% also. So if you see that this company is manufacturing many brands which are the top performing brands in their own industry. Now let us see the history of this company. This company had started in 1944 in India, and originally it was called Boots Pure Drug Company Limited. It started with a single manufacturing unit, and it manufactured initially insulin injections, vitamin preparations, animal health products. Over a period of last 10 years, it has started manufacturing more than 100 new products, and in the last 10 years journey, its turnover went from 767 crores to 3640 crores in 2019. During this journey, it has acquired a company called Solve Pharma, which helped its diversification into various products. Now let us see the milestones what this company has achieved during its journey. In 1944, it was incorporated in India as Boots Pure Drug Company. and in 1952 it launched a very popular medicine called Cremaffin. In 1965 it brought its IPO and got listed on Bombay Stock Exchange in 1966. In 1973 it launched Brufen. In 1995 the parent company of this company was acquired by NOL Group. NOL BASF Group. In 1996, it inaugurated its manufacturing unit in Goa. In 1998, it launched Cremaflax. In 1998, it amalgamation of Beam Healthcare Limited and Valencia Pharmaceuticals, the wholly owned subsidiaries with the company. So the group which acquired this a few years before, the NOL group, it merged the other subsidiaries of that group with this company. In 1999, it launched Thyronorm. In 2001, the BASF group, which recently in the earlier years acquired this company, that was acquired by a worldwide company called Abbott Laboratories. So that is why now it's finally changed to Abbott India Limited. So two times there were acquisitions from the parent company's side. In 2002, it launched Geneton. In 2003, amalgamation of Lenbrook Pharmaceuticals Limited, a wholly owned subsidiary within the company. It was amalgamated or merged into Abbott Limited. In 2011, another company called Solvay Pharmaceuticals was also merged into Abbott India Limited. And in 2017, the consolidation of offices happened and Abbott India became a single place of work in Mumbai. So this is the journey of the last 50 years of this company. Now let us understand the business model of this company. This company has a headquarter in Mumbai and it provides nutritional products, diagnostic tools, branded generic pharmaceuticals and diabetes and vascular devices also. Abbott India Limited is a part of Abbott Global's pharmaceutical business and it has in-house development teams to make products which are tailored to cater the Indian market. So its primary focus of Abbott India is the Indian market. It is not focused on exports. It in fact brings the global products to India and sells it in the Indian market. Let us discuss the market and the industry, the Indian pharmaceutical market in which this company operates. The Indian pharmaceutical market grew at a CAGR, an average growth rate of about 15% from financial year 2012 to 16. So it was growing very well from 12 to 16. In the last 3 years, it has slowed down a little and it's growing at an average rate of about 9.5%. And given the present scenario, it is expected to grow a little faster because of the COVID situation. Globally, if we see, the Indian market ranks in terms of value, in terms of amount, it ranks at the number 10, and in terms of volumes, it ranks at number 3 for the entire globe. The competitors of this company are Dr. Reddy's, Sun Pharma, Divis Laboratories and Cipla. There are many other pharmaceutical companies in India, but these are the main competitors. Now, what is the competitive advantage does this company have when compared to its other companies? How will this company have an advantage? This company manufactures a lot of market leading brands. It has a diversified portfolio of different pharmaceutical products and it has a legacy of over 75 years of presence in India. It has a global support from its parent company, which is Abbott Laboratories, and it has a global presence because it is a multinational company. So there are a lot of advantages when the company is a global company, and the company has no debts. It is sufficient, has sufficient cash, and it is operating comfortably, and it has very less employee attrition rates. That means the company's employees tend to work with the company for a very long term, and the management of the company is also very strong. What are the growth prospects of this company in the near future? How can we expect this company to grow? This company will grow by launching a lot of new products every year, and this company is trying to engage with the healthcare professionals like doctors and others through digital platforms. So this will build better relationships with the professionals and improve the sales of this company. This company is trying to support the patients, just not just by giving them medicines, but beyond that by taking various initiatives as we have discussed before, and it is also trying to connect with the patients to digital platforms. It is giving a lot of importance to the internal talent development of its employees, and people who are selling the products of this company, the medical shops and the other pharmaceutical distribution network, it is trying to improve the channel management of that distribution network. And this company has a continued consistent growth, and it is expected to carry forward the same growth. And there is a chance of international collaborations by manufacturing COVID related testing kits and other medicines. So if some foreign company wants to get something manufactured in India, Abbott will be one of the most preferred partners from India for it. Let us discuss what are the risks which this company may face while running its business. These are economical and political risks, because if the government changes some policies, it may drastically affect the pharmaceutical sector and this company. It could be regulatory risk, because this is a pharmaceutical company. There are a lot of regulations which are to be followed. If there are any lapses in those regulations, those will be dealt very seriously against the company. There is a body called National Pharmaceutical Pricing Authority, which monitors the prices of the essential medicines. So it has a list of essential medicines and it restricts the prices of essential medicines, and that list keeps on growing. So if the medicines of this company which they are manufacturing falls into that list, the profit margins of that medicines will slightly go down, because they will restrict it to be sold in that particular profit only. Now, after discussing the entire background, history, milestones, business model, everything about the company, now let us discuss the numbers. The financial highlights, the quarterly numbers. The December 2019 quarter turnover is 1078 crores, which is higher than the earlier December turnover of 1054 crores and higher than the September 2019 quarter turnover of 947 crores. So this shows that it is a consistent increase in turnover. The profit after tax of December 2019 quarter is 187 crores compared to December 2018 of 178 and September 2019 of 117 crores. So profit and revenue quarterly is consistently growing. Now let us see the overall trends. The revenue growth has been consistent over the last 5 years. If you see, there has been consistent growth of about 14, 11, 14 and again in the latest declared yearly results of about 10.7% in revenue. So the revenue is consistently growing. The EBITDA margins reported in the latest financial year 2019 are 18.9, which is a very good number, and there is a consistent growth in the margins also over a number of years. The profit after tax margin is declared at 11.9%, and there is a sharp rise in the profit after tax margin consistently. The return on capital employed is about 24.3%, and that also is consistently maintained over a period of 5 years. The reserves and surplus is also continuously growing, and the share price of the company is also consistently growing and it is on a rise. The book value of this company is also continuously growing with the other growth. The revenue year on year is 11% up, and the latest reported revenue in financial year 2019 was 3792 crores. The net profit was 450 crores, which was up by 12.25%. And this net profit was slightly affected with the increase in the cost of raw materials. Otherwise, the company would have reported even better profits. The earning per share was about 212 rupees, which was again up by 12%. And in this year, last year, the company had launched about 16 new products. It has declared a dividend of rupees 50 per share and special dividend of 15 rupees per share. So it's a dividend paying company, and the promoters holding is 75%. So that means it is a very good closely held company held by the promoters themselves. The directors remuneration of all the directors is about 10 crores, which is pretty decent. And looking at the balance sheet, it has maintained its equity capital consistent and there is no changes in that. The reserves are continuously growing. There are no debts in this company in spite of running such big operations. There are no debts. Cash, this is a sufficient company, and the cash balance, the cash and cash equivalence is about 1684 crores, and this balance is going on rising in the last 5 years. The net profit margin is about 12.24%. Return on equity is 22.5% and return on capital employed is around 33.5%. So all these ratios are pretty good. The inventory turnover ratio is 6x. That means it is able to sell its stock quite fast, and the cash flows are also positive, and the operation cash flows are about 500 crores for this year. So if you see, fundamentally this company has shown very decent growth and has very strong fundamentals. Now coming to the valuation part, the last traded price of this company's share was about 17,700 rupees, and 52-week high and low is 7,160 and 18,600. If you see the last 1 year, this company has given a return of about 144%, which is very good. And in the last 5 years, it has given a return of about 360% in spite of the lockdown situation. It has a market capital of about 37,800 crores. So it is a large cap company, and the PE ratio is 63, which is on the higher side. Industry PE is at 35 and the earning per share is 280 rupees. The price book ratio is 18.82, which is again quite high. The intrinsic value I have calculated roughly as per the Benjamin Graham's formula, and it is coming to around 6,100 rupees. So in terms of valuation, this company's share price has already accounted for its growth prospects, and it is already trading at a higher side of 17,700. So we should wait for the right opportunity to get into this share. Let us see the price chart. If you see the last 5 years price chart, it has a very strong uptrend, and in spite of the lockdown scenario, it has touched 52-week high in this month. Let us see some latest news about this company. Abbott is to bring COVID-19 antibody test kits to India by May end, and it has also got US FDA's approval for a 5-minute point of care molecular test for detection of COVID-19. So it is working on its kits and testing products, and it will soon be launching in India, which is expected to give this company a good boost in terms of growth and also to its share price. So I've given you all the indicators to help you decide whether or not to invest in this company. And to sum up, I will bring it to you. The strong, consistent performance of this company is depicted in the last several years, right from the beginning, and it has a 75-year-old legacy in India. It has global support and global presence. It has zero debts. It has very good margins. It has a very steady growth over a period of time, and it has given a multi-bagger returns in the past. The only issue is the valuations. If you keep a track and get into this company at the right price, I hope you will get a good return. So take a cautious and right decision. I hope you like this video, and I have liked making it for you a lot. Do subscribe to my channel and hit the bell icon not to miss any update. And if you have any questions about this company, do leave in the comments below. I will definitely reply to it. If you want me to make more videos on any other company and analyze the case studies, do mention the names of the companies in the comments, and I will try to make the videos on them very soon. Thanks for watching and have a great day.